In this presentation, we'll take a deeper dive into the balance sheet and show some of the differences between US GAAP and IFRS as they pertain to the balance sheet. The technical definition of assets is resources owned by the firm that will provide a future benefit. In other words, they are not used up, but still hold some future value to the firm. For example, accounts receivable are expected to be collected in the future. Inventories will be sold for cash. And machinery and buildings will be used to house the business and manufacture the products that will be sold. They all have in common this idea of a future benefit to be received by the firm. A couple of other things to note about assets. We tend to use a mix of valuations in recording assets. Many assets like inventories, fixed assets, and intangible assets are recorded at their historical cost, what the firm paid for them. While other assets like investments in marketable securities and other financial assets are recorded at their current market value. Not much we can do about this. You just need to realize that there are a variety of valuation bases used for assets. In addition, assets are grouped based on when they'll be used or converted into cash. Those assets to be used within the year are classified as current, and those to be used beyond 1 year are classified as non-current. Liabilities are defined as obligations of the firm that will be paid either in cash or services and are a result of a past transaction. Like assets, liabilities are also grouped as either current or non-current. Current liabilities will be paid or settled within a year. Non-current will be settled beyond 1 year. Stockholders' equity is really a collection of accounts that record different types of transactions with the owners of the firm. It can also be called shareholders' equity or owner's equity. The main accounts are common stock and additional paid-in capital. These two accounts together represent the amount of cash the company received when it initially issued its stock to the public, such as an initial public offering or IPO. This is not the current market value of the stock, but rather the amount received in the past when the stock was first issued. Retained earnings we've already discussed. It represents the cumulative net income or net loss of the firm less any dividends paid out to shareholders. Treasury stock represents the total cost of the firm of buying back its own stock from shareholders when the firm does a stock buyback or a stock repurchase. Since this type of transaction decreases the number of stockholders in the firm, it is shown as a negative amount or subtraction from stockholders' equity. And accumulated other comprehensive income, this is really a technical account, the details of which are beyond the scope of this course. There are slight format differences between US GAAP and IFRS balance sheets. US GAAP balance sheets are based on the equation assets equal liabilities plus stockholders' equity, while IFRS often rearranges that equation as assets minus liabilities equals stockholders' equity. And while US GAAP lists assets and liabilities in order of decreasing liquidity, with the most liquid assets listed first, IFRS balance sheets do just the opposite, starting with the least liquid assets and liabilities. For example, here's a sample of a US GAAP balance sheet for Kroger, the grocery store chain. You can see how total assets equal the sum of liabilities and stockholders' equity, and how the listing of assets and liability is in order of decreasing liquidity. And here is the balance sheet for J. Sainsbury, a grocery store based in the UK that reports under IFRS. Here, the overall format is to list assets first in increasing order of liquidity, then to subtract liabilities from this amount to arrive at stockholders' equity. It is really just a formatting or presentation difference more than anything else. It can be interesting to note the different balance sheet profiles that occur when firms are in different industries or employ different business models or operating strategies. Before moving to the next slides, think about how the balance sheets might be different for a product or service firm, or a firm that owns its own manufacturing facility versus one that outsources production to an unaffiliated third party, or a firm that prefers to grow internally versus another firm that grows by purchasing other businesses. The following slides provide some examples. First, Here are the balance sheets of Yahoo and Dow Chemical presented in percentage form. Two companies in different industries with different business models and strategy. Can you identify which column of data pertains to Dow Chemical and which one pertains to Yahoo? Post your best guess and the reasons for your decision to the discussion board. Does everyone agree with you? Same exercise. Here we have the balance sheets for Citibank and Nike. Again, decide which is which and post your selection and reasoning to the discussion board. And one more pair, Apple and Walmart. Again, decide which is which and post your selection and reasoning to the discussion board. Hopefully you all have a better idea for the balance sheet now. Next, you'll be able to demonstrate your understanding of the balance sheet with some questions for you to talk about on the course discussion board.